Welcome to The Explainer. Today, we're diving deep into the anatomy of a financial meltdown. We're going to trace the patterns, the psychology, and the all too real human cost of economic collapse, from the wild days of the Roaring '20s all the way to the warning signs we might be seeing today. All right, so here's how we're going to break this down. First, we'll lay out the basic blueprint for how these disasters happen. Then, we'll walk through the three classic stages: the dizzying high of the boom, the sudden shock that pops the bubble, and the absolute chaos of the bust that follows. We'll also look at the real human cost of all this, and then we'll wrap up by looking at our own time and asking that big question: are we seeing the same patterns all over again? So, how in the world do you make sense of something so huge and chaotic? Well, you start by finding the blueprint. It turns out there's a recurring pattern to these meltdowns, a sequence of events that repeats itself with, honestly, an eerie regularity. You might have heard this famous phrase before: irrational exuberance. It came from the Fed chair at the time, Alan Greenspan, way back in 1996, right as the dot-com bubble was inflating. He was basically pointing out that a kind of dangerous fever was taking over. People were buying stocks based on pure hype, not on their actual value. And that disconnect from reality, it's right at the heart of every single financial crisis. And this right here is the key. A crisis isn't just about red arrows on a stock market chart. It's about the sudden, catastrophic collapse of something way more important: confidence. See, when that trust just vanishes, the entire financial system can become a house of cards, and that threatens everybody, not just traders on Wall Street. Okay, so let's get into stage one, the boom. This is the party. It's that period of infectious optimism where it feels like the good times are never ever going to end, and prices just keep going up and up and up. At the heart of every boom is what we call a speculative bubble. This is when people start buying something. Could be stocks, houses, anything. Not for what it's actually worth, but because they're betting they can sell it to someone else for more money later. It's basically a giant game of musical chairs, and nobody wants to be left standing when the music stops. And wow, this slide just lays out the recurring theme so clearly. Just look at the parallels. In the Roaring '20s, you had wild stock speculation, all fueled by exciting new tech like cars and the radio. Fast forward to the 1990s, and you see the exact same craziness, but this time it's fueled by the internet. In both eras, people got so hyped up about market gains that they felt like they didn't even need to save money anymore. Like they say, history doesn't repeat itself, but it sure does rhyme. But you know how it goes. Every party has to end. And every single bubble, no matter how big and shiny it gets, eventually meets a pin. So let's look at the triggers, those specific events that make the whole thing burst. Now check out this timeline. It shows just how terrifyingly fast things can spread. This is the 1997 Asian financial crisis, and it all started with one single event. Thailand ran out of foreign money to prop up its currency, the baht. They had to let it float, which is just a nice way of saying they let its value plummet. That one pinprick caused instant panic. Investors yanked their money out of nearby countries, which forced the Philippines to jack up interest rates, and pretty soon South Korea's currency was in a freefall. A small fire turned into a massive regional inferno. So once that bubble pops, all that calm, rational thinking, yeah, that goes right out the window. It gets replaced by something much more powerful, much more primal: pure panic. This is a stage where fear literally becomes a self-fulfilling prophecy. A bank run is the classic example of this. I mean, think about it. Banks don't keep all your money as cash sitting in a vault, right? They lend most of it out. So if everyone gets scared at the same time and tries to pull their money out all at once, the bank physically can't pay them. The fear of the bank failing is the very thing that makes it fail. It's a vicious cycle, driven by nothing more than a collective loss of faith. The bust isn't just one bad day. Oh no, it's a terrifying cascade of failures, like dominoes falling one after another. Investors flee, currencies tank, and suddenly, all that foreign debt that's owed in, say, US dollars becomes impossible to repay. As you can see here, in some of the hardest hit Asian economies back in '97, their foreign debt shot up to over 180% of their entire GDP. The whole financial system is just teetering on the edge. You know, it's so easy to get lost in all these charts and economic terms, but we have to remember what this is all really about. The true cost of these crises, it's measured in ruined lives and just immense human suffering. This number is just staggering, and it's so important that we don't look away. 10,400.
That's the estimated number of people who took their own lives in just Hong Kong, Japan, and South Korea directly because of the despair from the 1997 financial crisis. This is the devastating human toll behind the headlines.
And the fallout just ripples through every single part of society. I mean, during the Great Depression, a quarter of the entire workforce was jobless, living in homeless camps they called Hoovervilles. In Indonesia, people's incomes were slashed by nearly half in just 1 year. And this kind of economic chaos can even shatter political systems. The turmoil from the 1973 oil crisis was a huge factor in the political storm that eventually led to President Nixon's resignation. This isn't just a financial story, it's a deeply, deeply human one.
All of this history brings us to a really critical and maybe a little uncomfortable question for today. Are we just ignoring these really clear lessons from the past?
According to financial analyst Warren Brucey, the trigger for the next crisis might not be some complex, weird financial product. It could be something far more basic, something a lot of us deal with every day: overwhelming consumer debt. He argues that while governments can overspend for years, regular people, we eventually hit a hard limit where we just can't make the payments anymore.
And this chart, wow, this is a massive warning sign. Take a look. In the 1980s, right before Japan fell into a long, painful recession, its consumer debt peaked at 130% of disposable income. Now look at the United States in 2007, right before the global financial crisis. That number climbed even higher, to 135%. It's like a flashing red light on the dashboard, suggesting that when household debt gets this high, the economy becomes dangerously unstable. So these crises aren't just random, unpredictable events. They're cycles, and they're driven by human psychology, that predictable pattern of euphoria, then panic, then pain. By understanding the anatomy of these past collapses, we basically have a blueprint to recognize the warning signs today. And as we see household debt levels climbing once more, the question we're left with isn't if the music will stop, but who's going to be left without a chair when it does.